Matthew Shapiro, president of MWS Capital, joins us. He is an options trader and a money manager. He's in the Chicago Board Options Exchange, just talking about that. And here with us in New York is Jason Pride, director of investment strategy at Glenmede. He helps oversee more than $19 billion at the Philadelphia-based firm. And Jason, we were just talking about your piece in the Journal today, or a piece in the Journal that sort of focuses on your strategy. It's interesting because it hits on what quantitative easing does to the cost of buying treasuries. It increases them, and then it sort of sends clients in a different direction for safety than you might expect.
Right. You know, the problem that people are going to have, and I think this is going to be a problem for a while, is that you're basically you're not getting paid what you should get paid to take any sort of risk in government debt. So when you're really kind of positioning for those long-term assets, you really do need to step out a little bit more on the risk spectrum. It's something that we are recommending to clients. We hope that we're a little bit ahead of the curve on that note, and we think that a lot of people are going to be doing this as we go forward in the next couple of years. You're getting paid 2.6% on 10-year treasuries is not attractive for anybody. You can't stay ahead of anything at those sort of numbers, so you have to do something about it.
What about the possibility that more quantitative easing comes out, that the Fed prints more money to buy more treasuries? I mean, you can play it on the price, right? Especially if you're a shorter-term investor. Right.
If you're shorter-term, yes, you can play it on it. And I think that quantitative easing, I mean, when you think about these numbers, $800 billion when Treasury issuance is going to be a little bit north of $1 trillion over the next 12 months is a pretty significant number and should keep rates low. But for a long-term investor, it still doesn't matter. When you're buying a 10-year treasury, if you're looking at a 10-year time frame and the yield is 2.5%, you're getting 2.5%. So from a long-term perspective, it is hard to stick around with assets like that for a long-term investment portfolio.
All right, so we're talking strategy, and we'll do some more of that in a moment. But I want to bring Matt Shapiro into this conversation. So, Matt, you're down there on the trading floor. It feels like we're really taking a bit of a breather today after the run-up in stocks last week. Talk to me a little bit about the mood there on the floor.
Well, actually, kind of a lackluster session. Very quiet Monday. The market was down, and the VIX was a lot higher earlier in the session, was up about $1, but the market seemed to stabilize even though we're finishing down. And the VIX back down to 18.5 shows that there was not a lot of conviction for the bears. This market seems to be crystallizing and solidifying here at these levels despite the weakness today.
You know, Jason, as we go through these earnings numbers, I mean, not a bad earnings season. So, again, we have that disconnect between a healthy corporate America and those that are still out of work. I mean, there's that disconnect still happening.
Right, and we consider this to be the missing link in the economic cycle right now. When you dig into it, corporations are beating on expectations to the tune of 65 to 70%, depending on which day you measure it. And revenues are even coming in ahead of expectation as well. Maybe not quite as good as they were, say, 1 or 2 quarters ago, but still pretty strong. But there's that disconnect to the hiring side. And I think what that really shows is there's this structural shift in the way employment works right now. We do have a mismatch of skilled labor. We have a mismatch of people in geographic locations that can't move for housing reasons. So it's not that corporations want to hire and they're just holding off. It's that there's something more fundamental. I heard a great anecdote today that was really interesting. You know, so a structural issue, and perhaps it's also driven partly by what we're willing to compensate people for unemployment-wise. I heard just today that many of the trucking companies are actually having a hard time finding drivers. Now, this is a not very high skill job slot that actually pays a significant amount, but requires a significant amount of effort and willingness to travel on the part of the employees. Yet they're having a hard time finding drivers in an environment where we have 10% unemployment. Gives you a sign that there are some things other than just companies not being willing to hire that are at work here. And I think a lot of it comes down to
tell you there's a great disincentive, right, to finding work if you continue to get unemployment checks. Not that that would be any better than having a good full-time job that you want, but it could dissuade people.
Right, and I think that's going on to some degree, but at the same time, there's also this structural mismatch that's also dragging the employment.
Matt, what's your perspective there from Chicago? I mean, Jim Paulson at the end of last week from Wells Capital sent me a note and pointed out, look, it took 12 months after the 1991 recession, and it took 21 months after the 2001 recession to start really creating private payroll jobs. And here, 16 months into the recovery, we're still creating more than we did in those last 2 recessions or in the recovery periods there. Do you think people panic too much?
Well, they do. And, we still got, about 7 million jobs to create before we get back to where we were. But I do feel with this market seemingly solidifying here, I think we're close to closing the chapter on these past 2 years and moving into sort of the next market paradigm, which is that these companies with good earnings, good dividends versus that 2.5% 10-year Treasury are looking very, very good against that backdrop. And the one worry, of course, we do have is that bogeyman of that big Treasury deficit out there.
Right. All right. Got to leave it on that. Hey, Matt, thank you so much. Matt Shapiro out there in Chicago and Jason Pride right here in New York. Jason, thanks.
Thank you.